For that, let's get to the big story of the day. That's the RBI monetary policy. On expected lines, rates were unchanged. But the tone of the policy turned out to be a little more hawkish than the market was expecting. Why is that? Latha is here to tell us more. Latha.
Well, the RBI didn't cut. That was always expected. The shock for the market was that the year-ahead forecast for the quarter April-June 2026 turned out to be 4.9% CPI. You know, when the repo rate is 5.5 and 4.9 is the inflation, for 0.5%, real rate, you can't cut rates. That was the message that was coming in. The market was kind of asked to, ring out its expectations of a rate cut, even on the growth front. The Reserve Bank retained that 6.5% GDP forecast, called it robust. And, so growth-related reason to cut rates also was not being provided by the Reserve Bank. When I proactively asked the governor, have you already included the tariff-related impact? He said, remember, we brought the GDP down from 6.7 to 6.5. At that time, we did take in, global impulses, and that's why we cut. So the market was left with a feeling that if growth is robust and inflation is so much higher a year ahead, where is the case? But my own sense is there were three, in fact, repeated instances when the governor said they would be data dependent. He said it in response to my question, that is in the first minute of the press conference. In the 5th minute, he said again, we will move meeting to meeting, we will policy to policy. And again later on, he said that he cannot preempt what the MPC will do in the future. So my sense is that growth is going to be very strong in this quarter, the April-June quarter, because, you can see the rural sales, and also both Q1 and Q2 has a very poor base effect. Because of the base, remember last time Q2 was all of 5.4%. Because of that base, we are going to get a 6.5% growth perhaps for the first half. But by the time we come to December, there would have been probably a couple of Fed cuts. There would probably be more evidence of severe second half fall, probably because of the global situation being so murky, that the RBI may look at the 1 year forward from next December, or they may point to growth. My sense is the door is shut perhaps for the September policy. I'm not quite convinced it is shut for December or for the forthcoming February, April. My sense is that if the weakness in growth and the 1 year forward inflation starts to look less ferocious, there could be a space, but not in the next policy.
Okay, so the wait maybe for the next rate cut gets a little longer. That's the takeaway from today's.
And that is what the bond market has also done by increasing the 10-year yield by 5 basis points, and the swap rate also not indicating an October cut.
Sure, okay, so that explains the market's mood as well, and not so much on equities, but more visible on the bond side after the policy today.
And the cheer on the bank side.
Yeah.
The banks have not fallen
They've not fallen, actually.
NIM pressure is less.
Otherwise, we have enough clouds of tariffs and so much more, but at least from this perspective, there's still hope in the future in terms of rate cut. Thank you for that, Latha. Well, we have to take a quick break.